Welcome, everybody. How are we doing? It's good to see some familiar faces here. I thought I'm going to open up today with a little perspective because I just can't get over it. I was sitting in my kitchen today watching the news before I drove into work. Okay? And the headlines coming across the screen were driving me crazy. I can't stop thinking about it. I think they forget sometimes. Guys like me, I'm a child that went through the 80s, right? I grew up with a seatbeltless childhood, riding bikes without helmets, living off hose water, right? I went through Black Monday, double-digit inflation. I saw planes flying to buildings in 9/11. I've seen financial markets melt down. We've got fires and flash floods and countless wars. And they're telling me the thing that's going to take me out is diarrhea levels. I mean, come on now. Like, with everything going on in the world, the last thing us Americans are going to be worried about is Caesar salad. So, a little perspective to open up today. For those of you that don't know me, my name's Chad Harmon. I'm one of the partners here at A&I Wealth Management. Been here for going on a decade and a half, and couldn't love the team that we have built here anymore. We're a financial planning firm, a boutique family-owned shop, and we specialize in working with folks just like you guys. Right? Our job is to help you take a lifetime of hard work and turn that into a lifestyle that you can be comfortable with and proud of moving forward. That's what it's all about. And we truly consider that a blessing. There's nothing else we'd rather be doing. And part of our give back is educational events like what we're here for today. Our topic is going to be the second quarter market update. It's going to be a lot of content. And I want to challenge you before we begin today to ask tough questions today. I think the more interactive we make this, the more we're all going to be able to pull out. Speaking of being interactive, we have a lot of folks joining us on Zoom today. We've made you invisible and we've hidden your names, put you on mute, not because we don't want to hear from you. We just want to protect everybody's privacy. So as questions pop up throughout the presentation, for those of you online, use the chat feature in Zoom on bottom middle portion of your Zoom window. Our team will be able to see those questions, and we're saving a lot of time at the end here for Q&A. So let me introduce our featured speaker today. It's our head honcho, Karl Frank. You've heard from him before. I think this is going to be a thought-provoking presentation. So there's a lot going on in the world to talk about, and I'm excited to hear all the details of what we need to be focusing on, Karl. So without further ado, I'll hand things over to Karl.
Thanks. Thank you. Thank you. Thanks so much. All right, I think I got my stuff in place here. Can everybody hear me okay? How are you all doing? You feeling good? Are you not paying attention to the news? How can you be feeling good? Right? Yeah, Chad, that's a great analogy. Yes, the lettuce, our doctor just sent out an email about the lettuce and said Avon cheese seeing cases. So apparently it's real. Apparently it's real. Well, let me look at the second quarter market update, and this is not synced. So we're not doing what we thought we would do. We are not able to move what's here with this device. So if somebody can help me move what's on the screen with this device. There we go. Thanks. Great. We're good. All right, let's give it a shot. Thanks, Chad. Appreciate you doing that. I just want to invite you to invite your friends and family to learn more about our firm. So this 2D barcode is something you can take a photo of. It'll pop up here at the end of today's presentation, and you can send that link to friends and family. They get up to 3 meetings with us free of charge. So that's up to 3 hours. And maybe they have a financial question, or maybe they have a more complicated financial planning issue. Maybe they're just worried about sending their kids to college, or should they pay off a mortgage, or how do I talk to my employees about selling my business? Whatever it might be, think about that and send them over to us. And as a service to you, we give them 3 meetings free of charge over 2 weeks, 3 weeks, however long it suits them. Okay, so let's dive in. Holy cow, it's been a wild year. So the first quarter of this year was negative, but the second quarter of 2026 was a sharp reversal. Could you hand me those eyeglasses? I'm in denial that I'm old, because I'm not old, right? I'm not old. I went to the eyeglass doctor and they said I could make do with readers, which means I'm still young. I need hearing aids, but not readers. The second quarter of 2026 is a sharp reversal of the first. Just 3 months ago, the first quarter delivered a decline of 5% in the S&P 500, but what followed in the second quarter was a round trip in risk assets. These are big percentage gains on the screen. The S&P returned 10.5% in April, its best month since 2020. It added another 5.3% in May, closing the month at successive record highs. By the time the quarter ended, even after a choppy June, the S&P had gained 15.2% for the 3 months and is now up 10.2% in the calendar year at the end of June, and maybe it's at 9.5, somewhere between 9.5 and 10% year to date in July. The rotation extended into foreign equities as well. Emerging markets led the way with the MSCI Emerging Market Index gaining 24% in the 3 months of the second quarter of this year. The memory and semiconductor demand drove Korea and Taiwan through the roof. Developed international equities also had solid returns, but failed to keep pace with emerging markets. The broad MSCI EFI index returned 10.8%, European stocks gained 11%, and Japan surged 14%. Fixed income offered its own version of the quarter's round trip. The Federal Reserve made no change to the policy rate. The June meeting marked a fourth consecutive hold. So the Federal Reserve rate is still between 3.5% and 3.75%. The broad Bloomberg aggregate bond index returned about 0.2% for the quarter. That's 0.67%. Credit stayed calm. High yields gained 2.5% during the quarter. What a remarkable quarter. Does it feel like it was a good 3 months? Does the news match the reality in our portfolios? It probably doesn't, right? It probably doesn't. And I think that's going to be a theme for today. Really, I've got a lot of questions and not a lot of answers for us today. I've just got things I want us to think about as we go forward in the world, because I don't think we're going to have answers until the news has already happened, right? So just be thinking about that. The first on the list is the conflict in Iran. A loosely held ceasefire took place in early April. Through the middle of the quarter, a Pakistan-mediated framework gradually took shape, culminating in a memorandum of understanding announced in mid-June. The market's response was swift and one-directional. Brent crude, which had peaked at $118 a barrel for oil, fell 26% right away in May, back into the mid-80s. Oil prices fell further in June as the ceasefire framework took hold. And then July came around, and this memorandum of understanding apparently is gone, and the war is back. And where is Brent crude today? Well, I don't know, but here's what I got. I got a real insight. What I have is the answer to that. Oh, I don't have it. I don't have it. Never mind. I'm going to go back to where I am. All right, so skip it. I had it, but let's bounce that up back to the fills the whole screen mode. I lost the website. But at finance.yahoo, you're going to find Brent crude's around $85. And you're also going to find almost every headline today is negative on finance.yahoo. And yet the market's good, right? And so what I'm asking you is why you're still paying attention to the news. I don't know why. Why are you still paying attention? Why do you care about the price of oil? You know, I think there's a lot of reasons to that, but they're not financial. Higher energy costs enter the data is our next slide. The inflation data released during the quarter told the story of the energy shock working through the system with its usual lag, just meaning that energy prices go up and then a few months later we feel the prices increase, right? Maybe this is the reason why you worry about energy. Maybe you've just been told that you need to worry about the price of Brent crude. By the time the conflict supply disruption was working through the inflation readings, the conflict itself was already de-escalating. So by the time we felt the prices higher at the pump, prices are already lower at the Brent crude, and now they're higher again, and we're feeling it at the pump again. I don't think any of us know what's going to happen tomorrow, right? I don't think we know whether prices are going to drop another 26% in 24 hours. Headline PCE, which is a measure of inflation, accelerated to 4.1% year over year in May, right? You can see what that did over years, right? That huge spike you see here. Actually, we are... All right, well, that's fine. We can stay on the slide and run. Just don't change it yet. The producer price index rose 6.5%. The prices we pay rose 4%. And the Federal Reserve preferred gauge, which is consumer expenditures index, was only 3.4%, which is the highest it's been in 3 years. Leave it. Don't touch it. The sharp increase in energy prices drove inflation higher. Energy accounted for more than 60% of the monthly increase in consumer prices. The energy basket was up 23%. And to date, the current inflation episode has largely been a supply-driven energy shock, which is completely different than what we had the last time we had inflation. So if you look at this chart, you're going to see in 2020 and 2022 and 23, energy prices also went up, but inflation went up much higher. And a lot of the reasons for that had nothing to do with the supply of oil, right? Today's a supply of oil problem. We got an Iran war, and Iran's not going to supply oil to the rest of the world. Right. And we're not going to get our oil from Russia, even though America produces way more oil than anybody else in the world right now. It's a supply side problem. And so the deep question is, do we care? Because what really drove inflation the last time around wasn't about the supply, it was about something else. It was a demand side thing. And in these years, if you remember, the problem was massive amounts of money after COVID. We printed huge amounts of money. There was a huge amount of money chasing a limited number of goods. So it was a demand problem that caused the inflation that I think we're still feeling, right? We don't have that problem today. That was a long-lasting problem. The last time we went through this just a few years ago, it's a wonderful experiment. It's a thought-provoking time to think about, do we really care about inflation the way it is today? The prices are a little bit higher, but I think a lot of us are feeling it not because of the financial situation we're in today. I mean, I know everybody in the room, we're all really good friends. We've known each other, most of us, at least 10 years, some of us 20 years. It's been a long time, right? But we have a little bit of income. We have a little bit of financial assets now. We're not the ones who the high gas prices are hurting, right? I think we remember when we were those people, though. Like everybody here made their own money. I don't think anybody in the room and online, maybe it's not the case. I don't see you online purposely, right? But maybe you're remembering when you were younger and this did matter. And also maybe you know people who it does matter for. Or also maybe you're reading about how it really hurts other countries in the world where that does make a difference, where they are driving mopeds. And if gas doubles for the moped driver, that means they might not feed their family that night, right? That's the reality of what we're feeling, but not what we're paying. So maybe the oil price is something you can completely ignore because nobody had any idea that it would drop 26% in 24 hours, and nobody has any idea whether it's going to rise again, and nobody knows how much energy is going to affect inflation in the future also, because we're in a period of change with our government, and the government is changing the way inflation is going to be measured, and energy will be a lower number, a lower part of inflation going forward. Let's talk a little bit about the government. There's a new leader at the Federal Reserve. Now, why do people hate this guy? This is the new leader, Kevin Warsh. He's getting a lot of negative publicity. This looks like a guy I could ride a bicycle with. This looks like a guy I go to church with. We could have coffee, right? He looks like a nice dad, is what he looks like to me. So on the right-hand side of this picture beside the new leader of the Federal Reserve is a dot plot. And what this means is everybody who has a vote in what the Federal Reserve is going to do with government, with the interest rates, has a vote. And all the different dot plots is their forecast. So the voters get to decide. And so they put their dot on where they think interest rates should be this year, next year, the year after, and in the long run. And in the long run, you're going to see that's the only thing that really matters. They think it should be around 3%. The vast majority of people who have a vote think it should be around 3%. And we're higher than that. Remember, we're at 3.5%. The new Fed chair, Kevin Warsh, delivered his first speech in June. It's very different. The FOMC, the Federal Open Market Committee, definitively has a hawkish tilt. Hawkish is fancy Nancy word for they think they're going to raise rates. Warsh announced 5 task forces. Well, that's new, right? A government has a task force? I'm being a little sarcastic there, but this one actually they might do something with. Both inside and outside experts will give recommendations by the year end. And why do I think they're going to do something? Because he's already doing something different. Show the next slide. And this is what they said at their, this is what Warsh actually said. All the striked out words are what his experts said he should say. And the words he left actually makes sense. So it's no longer the Greenspan era. It's no longer the Bernanke era. It's no longer the other leaders in the past. This is really different. This little guy, I mean, he and I might like have coffee after church, but it's going to be really short. He's going to say, you know, let's go climb a rock wall, right? Let's go get busy. He's not a guy who's just going to sit around and chit chat and hype you up. Warsh has been critical of how much the Fed communicates and is not a proponent of the FOMC guiding the market. Imagine that. One of the first illustrations of the new FOMC came with a meeting statement which contained much less explanatory information and is potentially indicative of the communications under the new governor. It's also possible that that dot plot that I just showed you will go away, which would be a wonderful thing because Warsh declined to put his dot on the plot. Isn't that a funny thing to say? I love that. I'm going to read what he said, though. There's all these words, but here's what he actually said. Any of us can understand what the Federal Reserve actually said. It's really, really nice. I'm not going to read. I am going to read all of it. All right. I can't even read my glasses because I don't need them because I'm so young. The Federal Open Market Committee approved the following statement for release by a 12-0 vote. They always do that. The committee decided to maintain the target range for a federal funds rate between 3.5% to 3.25%. In support of the Federal Reserve's dual mandate, the committee reaffirmed its policy of maintaining ample reserves in the banking system. Everybody can understand this. This is not all the crap that went away. We don't need. Economic activity is expanding at a slow pace despite elevated uncertainty that owes in part to the conflict in the Middle East. Didn't we just talk about that, right? That makes sense. And then productivity growth and capital investment are strong. Job gains have kept pace with the workforce, and the unemployment rate falls off the screen because who cares? It's a really simple statement. It's completely different than the news media cycling around what the Fed did mean or didn't mean, what the Fed might do, what the Fed might not mean. It's been decades of wasted airspace, in my opinion. The Federal Reserve Chair is the referee on the side of the World Cup match, right? He's either going to throw a yellow card or a red card, but he's not going to hit the ball on the goal. It's about time that the Federal Reserve act like that. They're the ref. They're not the player. So I'm kind of excited. Like, I really like this guy. I like this guy. I think it could be good. I think it could be good. And he's hawkish, which is hard to be in an administration which has so much power and pressure to be the opposite dovish, right? President Trump wants lower rates, and this guy is going to go this guy's way, it looks like. So that's really an interesting time. It's just something to think about, right? I don't have an answer to that. I don't have an answer to that. I don't know that there's a conflict, and I don't know who's going to win a conflict if there is a conflict, but I know what he's doing is about time, in my opinion, for the Federal Reserve to do, to act more like a ref instead of a mover, instead of the center of attention. Interest rate expectations have moved from cuts to hikes. On the right-hand side, you can see what people are expecting today. Now, the Reserve has always moved only in quarter point motions, and all the rows say out into the future. But you can see today everybody's expecting a rate increase. But just a few months ago, it was a rate decrease of much higher numbers, of between 0.25%, 27 basis points, all the way down to 74/100% decrease in rates. Now it's the opposite, right? So people are expecting higher rates, and higher rates, I just want you to think about. Also, I don't have an answer to this either. Higher rates are not good for your growth equity investments, and our portfolios are distinctly tilted towards growth, and so that might not be great for us. And so I want you to just hold that in the ether for a little bit and think, what does that mean for me? And what it means for you is there's a little bit of a downward pressure out there. So things are amazingly good, and it's been amazingly good for a long time. You might not even remember when it was not good if you just looked at the numbers on your account statements, because they're up and they're up and they're up and they're up and they're up. And yet the news media is all bad. And there's a guy who in charge of the Fed who may just be a referee who's going to say his dual mandate is to fight inflation and unemployment and fight unemployment to help employment. And he might do that. And that might be a downward pressure on our growth stocks. So maybe we want to be a little bit diverse. And I think you'll find out when you talk to your advisor that might already be happening inside of your portfolio. There's activities that may already be going on. All right, so it's difficult to overstate the good news. It's difficult to overstate the amount of capital being invested due to artificial intelligence. At the end of June, it was 850 billion is what this will show you, that these big companies, these hyperscalers, are spending. I'm going to talk about hyperscaler in a minute and tell you what that means. The largest information technology companies have earmarked nearly $850 billion. I looked this morning. It's bigger than that. According to the thing I looked at this morning, it's $957 billion. I also looked this morning at how much was spent in all of China over the past 2 decades to build all of their infrastructure. And if this hits $1 trillion, it's more than China spent in the past 20 years to build all of those mega cities, to build all of that massive, fast train infrastructure, all of that IT, all of the money that was spent to build up China is less than what these guys are spending on artificial intelligence, on stuff you can't even touch. And spending continues to outstrip expectations. We're not even over. Let's go to the next page. Where is it going? Well, NVIDIA, the AI spending poster child, reported $81.6 billion in revenues. That's up 85% year over year for one of the world's largest companies. 85% year over year revenue growth is astronomical. This is real revenue, real profit, in most cases, capital spending funded out of free cash flow from the spenders, not out of debt. However, significant equity and debt issuance from these hyperscalers during the second quarter marks a divergence from internal cash flows from the CapEx. So before I go to the next slide, I'm going to ask my artificial intelligence, what the heck is a hyperscaler? Hyperscaler definition in 2 sentences or less that a person can understand. All right, so my artificial intelligence says hyperscalers are giant tech companies like Amazon, Microsoft, and Google that run enormous cloud computing networks capable of scaling up instantly, support millions of users and huge data loads worldwide. They provide the superhighway infrastructure that powers everything from Netflix streaming to AI training. Not bad, right? And pretty fast, right? That's the use of AI today. That's not the future of AI, right? That's what we can do today. Anybody can do that for free instantly from your little whatever AI I just used. I don't want to promote any one of these hyperscalers products over another, but I will give it away at the end, which one I used. AI today is handy. We don't need to invest in a hyperscaler to benefit from that. Just like I did it for our presentation today, that made me more efficient in my industry, right? And you can do that in any industry. All the industries that we're invested in are benefiting from AI. The way to invest in AI might not be to go after the next big idea, right? The way to invest here might be the way that it worked in 2000 with the internet boom, which was to be humble, to randomly in January diversify out of the companies that were hottest in 1999 in the dot-com boom and buy the other companies that hadn't caught up yet. And that's in fact what we've done in your portfolios already. And in some ways, it's already paid off. But the second quarter was tech or bust. In fact, this is the first time in my investment career in 35 years where only one sector in the S&P 500 outperformed every other sector in the S&P 500 and the average return that the S&P delivered. In other words, if the S&P 500, all 500 companies can be divided into, say, 12 different types of companies, sectors, you'd think on average, 6 of them would do better and 6 of them would do worse than the average, right? But that's not what happened. And this is the first time ever that I can, in my career, where only one of the 12 did good. Only one of the 12 was so much better than all the rest of the 12 that it brought up the average. So 11 sectors did worse. One sector did so much better than all the rest that the average was better than 11. All the money is going into technology. You're going to see a slide here at the end that one of our research partners, I put up his handsome face in a really nice suit at the end because he's just a good looking dude, just like Kevin Warsh, right? There are some good people out there, but not all crooks and criminals like the news would have you believe. And they're going to say, just be a little bit humble. Sounds pretty good. I think it's going to work this time, just like it worked with the dot-com boom way back then, right? Do I think it's a boom? I think everybody thinks it's a boom. Do we know when it's going to go bust? Nobody knows when it's going to go bust. What worked back then? Being humble and diverse. What worked back then? Buying profitable companies. And as I'm about to show you, profits are through the roof. All right, so before I get there, though, the tech weight in the U.S. in economic and emerging market indices is higher than it's ever been. In fact, it's not just the U.S. S&P 500 that's all technology. It's now emerging markets, Korea and Taiwan. The dark blue line on this screen shows the percentage of the S&P 500 that depends on one sector, technology. The whatever this color is, Stacy, what color is that? I don't know, kind of greenish blue, teal. Chad says it's teal. Turquoise. Don't ask a man what the color is. I mean, he volunteered it. Okay, so anyway, that's emerging markets. It's now a bigger percentage. So in other words, they are more concentrated in the emerging markets world in technology than we are here in the US. They are extremely reliant on artificial intelligence spending. That $1 trillion is going into a handful of technology companies. That makes them, in my opinion, if you just buy the indices, if you just buy the really inexpensive ETFs that just benchmark and don't have a reason for doing it other than that's the benchmark, you're taking on more risk than you used to. And it might be, and this shows only 7 years, but it could be a bigger risk than we've ever had before. Now, the other margins that you see on here are other ways to invest internationally. And these are just the indices for Europe and all of the rest of the world. and you'll see that they don't depend nearly as much on AI. And all of those companies, like I just showed you, just like my little company, our little company, can use AI to be more efficient. So you can be invested in AI and not be invested in one of these hyperscalers. The S&P 500 earnings growth have never been better, and the growth expectations are huge. Now, this chart I couldn't make prettier. It's really unfortunate. It's one of the handful that has a typo. It's not acutable, it's actual, if you can actually read that really small font. And every quarter you'll see here, one bar shows what they expected, and the other bar shows what they actually did. And in every single case, the light colored bar, whatever that color is, beat expectations every single time. And the expectations for earnings growth, that means how much money they expect to make more than they made last time, is 23%. Across the S&P 500, these are huge companies that are expecting their earnings are going to grow 23% year over year. That's massive. That's massive good news. The companies have never been more profitable. They're becoming more profitable, and they're hitting these numbers that are astronomical. It also means if they miss, it could be kind of ugly. And if they miss, it's probably because of the technology companies. And if they miss, the folks that aren't diversified will be hurt worse than us. Now, the bond market is a different news. And I don't have an answer for this either, right? Because there are concerns in the bond market that are not showing up in all that good news I just gave you in the equities. The bond market spent the second quarter telling a more cautionary story than the equity market. In mid-May, the 30-year Treasury, that's the stuff that the government yields that you have to wait 30 years to get your money back, it spiked to 5.18%, which is the highest level in 19 years, before easing back below 5% by the end of June. I'm going to show you what that looks like in a second. What I wanted to show you here is some perspective, because you see that horizontal line there. This is like not going anywhere, right? We had really low interest rates when the government started printing money after the great financial crisis in 2008, and we've had them since then. But if you look back into history, this is your mortgage rate. When did you buy your first home? 1980? It was close to a 19 or 16% mortgage rate that you might have had, right? In the 80s, interest rates started declining. And during most of your life and all of my career until recently, interest rates have declined on a general basis year after year after year. In the 90s, when we got our first mortgage, it was in the sevens, right? And that was about average. In the 2000s, your mortgage rates started to go lower than 7, and many people locked into those rates right before the great financial crisis in the 3s, right? We'll probably never see that again, because the long-term average is about where we're at, or even higher than where we're at, even higher than where we're at. So you can see that this long-term history here says these are good times for bonds, even if the bonds give us some warning signs, and they are, and here's what they are. And so this chart, unfortunately, the scale is not great, and the font is really light. It's one of these that I couldn't change the color on. But the line below is where it was 3 months ago, and the line above is where it is today. And on the left-hand side, you'll see how much you get paid if you give the government money for 3 months. 3 months later, they give all your money back plus 3 months worth of something like 3.8% per year, so not much money. And on the far right is how much money they'll give you per year if you waited 30 years to get your money back, and that's closer to 5. And rates are rising in anticipation of the Federal Reserve raising rates. So I'm going back to Kevin Warsh, who might just be finally somebody saying, actually, I'm not in charge of rates. Actually, the Federal Reserve is not in charge of rates, because the Federal Reserve did nothing and the rates rose. The market is in charge of rates. Right? The Federal Reserve is the goalkeeper. They're not going to shoot the ball into they're not the goalkeeper. They're not going to shoot the ball into the goal or keep the ball getting out of the goal. They're a referee. And it's always been that way. And I think perhaps maybe we have a new perspective that the news media, full of terror and piss and vinegar, are going to have to find a new enemy to blame it on. Because it's not going to be the referee. Unless he starts using video recall and it takes hours to understand what he just said. All right, yields. So yields across the world. What this is showing here is the difference between small companies, the amount of money they borrow, the rate they have to pay, and the companies all around the world. And when these two lines get closer together, it means things are good. When they get far apart, like they spiked, and unfortunately the time frame disappeared. But at the beginning of this quarter, they spiked far apart. So at the beginning of the quarter, it looked like the market was saying, uh-oh, we're at risk, right? There's more risk. Now at the end of the quarter, they're saying lower risk. And none of this means anything for our investments, except that our bond managers would have done better to have bought at the beginning of the quarter because they would have gotten higher yields than to buy now. And so bonds are not all saying bad and bonds are not all saying good. Bonds are saying things are changing and we're reacting to it. All right, so let's go back because there is something that we can predict, and that's there's going to be an election. And so we don't know what's going to happen on Iran, and we don't know what's going to happen in Venezuela, and we don't know what's going to happen with oil prices, for goodness sakes. So it's like we really don't, we've never been able to predict interest rates. And the market over short periods of time is a slot machine, but over long periods of time is a voting machine, and the money will act pragmatically and rationally and move into profitable companies. Over an election year, you've got a lot of uncertainty until the election happens. And so Capital Group, to gauge the impact, examined 90 years of the S&P 500 index, and it turns out that stocks exhibit some unique characteristics during a midterm election year, like the one we're in. Market volatility rises, returns are muted, and once the outcome is known, stocks rally. And I think we're experiencing that this year. So far, the competing forces of rising earnings, like I said, their record, Iran war, and a powerful rally in these artificial intelligence stocks, all the things we just talked about, are driving market activity that could change as investors turn their attention to a rancorous election. You thought the news was negative this far. It could be much worse, especially as we start seeing artificial intelligence start to create these ads. I can't imagine how ugly things are going to get. The silver lining is that returns have tended to be really strong afterwards. So the news will continue to be bad, and your investments are likely to be good because that's what they were in the past. For long-term investors, these short-term moves don't generally mean much. What do I mean by rising? Well, this bottom chart shows an election year, and you can see month on month what the average returns are in these midterm election years. So in January, maybe on average over 90 years, 0.1% for the month of January. You can see in November and December, though, look at how in an election year, these average monthly returns just for that month are closer to 4%, maybe even higher. Right. So it tends to be really good after the election's over. And all the other years, you can see the pink thing. So for most of the time, and that doesn't mean that the pink line ended up higher, that all the other years are better years for elections. It means that in all the other years, they had really good years. Look at the next chart, which is the summary of what I just showed you, but in real numbers. Yeah, go ahead. So an average 1 year return after an election is twice what a non-year election return is. Twice. Almost. 15.4 is almost twice the 7.8% average return. So hang in there, man. Hang in there. That's the point. I think you can make up reasons why that's the case, and maybe there's no correlation. Maybe there's no causation. Maybe there's no explanation. But the ones that you can think about that do make sense are just, well, now we know who's in charge, and now we know what companies are going to benefit from the graft. Okay, so here's that guy. Martin Romo is the chief investment officer of Capital Group, one of the big research firms that we use. And he said what I said, only more intelligently with fancier words and nicer suit. We should not simply mirror the risk profile of an index when that index becomes unusually concentrated or extended, as is increasingly the case in markets around the world today. Right? All the money moved into AI, and a lot more money is going to be spent on AI. But all the companies are benefiting from it, even little old our company, right? Even us. So we don't need to bet all the money on AI, artificial intelligence. So that's my presentation. I have one more slide with one of the most polarizing people on the planet. And so some of you hate it already, just because his name's in the top left-hand corner. But this is a quote that we were introduced on Monday when we interviewed the company that got us into SpaceX before the IPO. And if you're in one of our usual portfolios, you got into SpaceX before the IPO. And that was probably very accretive for your portfolio. I can't make any promise. Sorry, talk to your investment advisor. You can show you how much that meant for your portfolio. But like everything here, it's very diverse. It would have been large gain on a small percentage. And this is a company that, according to its CEO, could be worth more than Earth. I don't know if that's just braggadocio, right? I don't know if that's just one of these posts that goes social, because I don't think it's saying that this company is going to take over the world. I do think it's creating a new economy. I do think that there's a universe of growth. And the reason why I'm thinking that is because today, and you know, I started my career in 96. We could not imagine in 1996 how much money there is in the world today. It is so much more wealthy than it was back then. We went to college before the internet. The world has dramatically changed since then. Chad's, I don't know, a few years younger than I am, right? The 80s, you know, we were a few years ahead of you back then. But all the experiences you had back then, and you mentioned some of the scary ones, it was a dramatic period of change back then. And the market was shooting through the roof. And the 90s, when the internet changed everything, the market shot through the roof. In the 2000s, the market had to recover from its overexuberance. That may be where we're at. In the meantime, profitability shot up. All sorts of companies made a lot of money during that period of time. And the internet changed and created an entire new economy. And it wasn't just the Amazon that came out of nowhere that you had to make money off. The Walmarts, the Costcos, right? All these are examples that we can see and shop at every day. They all found ways to make a lot of money off of that new technology. And I think that may be the case with what's happening here. Only this vision could be even bigger than that. That's what I'm going to end you with. I don't have answers to any of this. We're going to have some tough questions here that some of our clients have already sent us. But if you have questions right now, please ask them. And think about inviting your friends and family. We'll leave that barcode up and they can, you know, we can offer financial planning advice is what we can really do. Okay, thanks.
Awesome. Great.